and then the webinar starts. Hi, this is Alan Gassman, and we welcome you to More Mathematics of Estate Tax Planning. I give you fair warning, Brandon had a distraction this morning, and he was going to be the one to do the more mathematics. So this is going to be more of the same mathematics to a large degree, but I've had many suggestions from a lot of the viewers, the 5 of you who are still out there, that I should slow it down and make it clearly understandable to everyone involved. So what I'm going to do today is almost exactly what I've done in the past, but maybe it'll sound different, or you forgot, or I'll think up of a new joke, or maybe 2 new jokes if we're lucky. I am joined today by Albert Einstein, and thank him for all of his pioneering work in mathematics. And people say that he was one of the greatest geniuses of all time. And what did he do to become a genius? Well, number one, I'm sure he was born a genius, but number 2, he figured things out. He liked to figure things out, and he liked to visualize things in ways that people had not visualized them before. So if you want to be a genius, step 1 is decide to be a genius, and step 2 is to find new ways to look at things. Please put on your calendar every Saturday, 11 a.m. Eastern Standard Time for the rest of your life. And we'll keep this going as long as you keep appearing. And we do appreciate any recommendations you have to friends who may not enjoy our webinar. If you want to torture them with this information, we do have our YouTube library. Now, at 1 p.m. today, we're doing a dress rehearsal for an AICPA conference that we're going to have in Las Vegas the last week of July. And if you don't want to attend it in Las Vegas, you can watch it at 1 p.m. today or catch the rerun. And it's going to be planning for the sale of the distressed business entity. And we're joined by some very bright CPAs who specialize in this area, and I'll call him a corporate raider, someone who buys businesses out of bankruptcy, and I'm going to help moderate. So it should be interesting, or at least semi-interesting. And then July 21st, a couple of my favorite people, Michael Lehman and Professor Jerry Hash, are going to join me to talk about charitable planning for business owners, what business owners should know about being charitable and charitable planning. That's a very interesting topic, at least for me as a tax lawyer. So please join us. And then please sign up for the Notre Dame Tax Institute. Jerry Hesh has just announced the schedule, and I am so proud to be speaking on Friday, October 22nd, virtually, with my hero, Jonathan Blottmacher, on tools and strategies to avoid ethical issues. So, and then my partner, Christopher Denicolo and Brandon Ketron, are going to talk about spousal limited access trusts for 2 hours for the Notre Dame Tax Institute. So I'm very proud of them. Can the 5 of you who are watching get some kind of CPA? Well, Claire, yes, I have good news for you. You can get some kind of CPE for today. You could just attend someone else's program who gives CPE, but I don't know where you live or what your rules are, but I'm glad to give you a certificate. So anybody who wants a certificate, just send me an email, put the word certificate in the RE line. I'll send you a certificate, and then if that qualifies for TBT for that, that's fine. At the end of the talk today, I'll give another advertisement, shameful self-promotion of the EstateView estate tax planning software. This is free for any clients of ours, and it's been a hobby over a number of years to develop this with Professor Jerry Hash. It's only $79 for a subscription. I'll be surprised if anyone buys one, but everyone who's bought them have enjoyed them, and they are very educational. So here's a question, and I haven't seen this question before. You often use the example of selling a non-voting interest in an LLC to a gifting trust and taking back a note at a low federal rate. If one were to sell 99% of the non-voting interest in the LLC worth $10 million, there would be a discount of, say, 30%, or $3 million, so a $7 million note goes back to the grantor. The note would be included in the grantor's estate. Is this all correct? Yes. Now, a lot of people ask me why I use 30% or 33% in my examples, and it is simply a matter of convenience. If you ask 3 different valuation firms for a percentage discount, you're likely to get 3 different answers. And sometimes, quite candidly, the law firm should always hire the valuation firm, whether it's a real estate appraisal or whether it is a valuation discount report or appraising a business, because once the appraiser makes any determination, and any and everything that you share with that appraiser, including snide emails back and forth, will be discoverable by the government or anyone else involved. So it is not unheard of for the law firm to hire 2 or 3 appraisers and pay them $3,000 or $4,000 each for their initial thoughts and an estimate of value. And then the one that comes in with the, I'll say, best, considered to be most accurate valuation, also known as the lowest, can be hired. And if the lawyer paid all 3 of those appraisers, the only one whose information and data becomes discoverable is the valuation report that you actually use. But once you use a valuation report, once you use an expert, everything you have swapped with that expert becomes accessible in a deposition and discovery. So now, is the $3 million note included in the estate when the person dies? Well, that depends on whether it is a self-canceling installment note. And I'll be showing you the numbers later on why, instead of a 1.5% 30-year note, which is permitted under the valuation tables, we may go with a 7% note that cancels if the note holder dies within the first 15 years, for example. And the good news is, if the person dies within the 15 years, it's not included in her estate for estate tax purposes. And somebody may not like her and be glad that that happened anyway. But the bad news is, if she lives beyond when the note balloons, then she is going to have a larger estate because of the higher interest rate on the note. So we have had clients call us and say, well, I'm going in for a heart procedure. I have a 90% chance of surviving, a 10% chance of dying on the table. Well, let's convert the note to self-canceling. And then if you die, it will be less of a sad event for your family. But if you get all better, we'll convert the note back to non-self-canceling. Now, if you have a note at 1.5% interest only for 30 years, you are allowed to give that note in exchange for assets, even though the note is worth a heck of a lot less than its face amount. So for example, I put $10 million worth of assets. That would be Marcia's shoes, purses, and jewelry. I put those into a trust in exchange for a $10 million note. Now the note only pays interest at 1.5%, and that would, if that is the long-term applicable federal rate, in effect, in the month that I make this exchange, the note is not a gift. But if I die a week later, what would you pay me for that note? Right now, the discount rate for a note like that is probably 4 to 5%. So you run a spreadsheet discounting every future payment and the balloon in 30 years, and you come out with a 70, 75% or 60%. So a $10 million note then valued at $6 million. So that's why clients say to me, well, why would you do the sale, Alan, and then have me have a note for 10 million? Why don't I just make a gift of all those purses and shoes and jewelry into the trust and file a gift tax return and use 10 million of my exemption? And the answer is, I'd rather not use 10 million of your exemption. If you might die, I'd rather discount that note and you would have a lower estate. And then there's something else I might do with that note. I might, for creditor protection purposes, put that note into a limited liability company. I don't want to owe a note. I don't want to own a note. I'm going to own a limited liability company that owns the note. And I'm going to have that limited liability company owned in part by my daughter because I want it to be a multiple member LLC for creditor protection purposes. So what is 95% of an LLC worth? And 99% of an LLC, if I keep 99%, my daughter owns 5%, 99% of, 95% of an LLC is not worth 95% of the value of the asset in it. A recent tax court case says you can get a 3% discount. So now I've got a $10 million note. It's worth $6.5 million. 97% of $6.5 million is worth $6 million for something. And I die, and my family is very happy that I did not just make a $10 million gift. They now have another $3.5 million worth of assets passing free of federal estate tax, leaving them more money to buy more purses, shoes, and jewelry, not to mention the value of the California closet. So let's go back. But it gets better. It gets better because charging order protection may not apply in the future. So what I might do with that LLC is give my daughter a 1/2 voting member interest and a 4.5% non-voting member interest, and I may keep a 1/2 voting member interest, 94.5% non-voting member interest in that LLC. And now that LLC is not worth 97% of the value of the note. It's worth 65% of the value of the note. And 65% of $6.5 million is what? About $4.8 million. So then I die unexpectedly, and my family pays tax on $4.8 million. And maybe that puts me under the exemption, and it doesn't even have to be filed on a federal estate tax return. So thank you for this question on page 12. And I'm sorry if I didn't answer it completely. This is the estate plan for many of you who are on this program. This is the revocable trust of the first dying spouse, or you have a joint jest trust, a JEST trust, or you have a community property trust. And we just did a Lineberg program Friday on the community property trust, which is a very, very interesting topic, at least for geeks like me. But what we want to do is we want to situate the married couple's assets so that on the first death, whatever is left of that estate tax exemption will go into a credit shelter trust, also known as a family trust, also known as a generation skipping trust, which can benefit the surviving spouse without being subject to federal estate tax when the surviving spouse dies. Now, if you don't use your entire $11,700,000 exemption, what's left of it can go to your spouse to be added to the spouse's exemption under the portability rules, but it's not as good as funding the credit shelter trust. Why? Number one, portability doesn't grow with the consumer price index. Number two, if you remarry, you can lose it. You're stuck with your next spouse's portability allowance, which may be zero. And number three, the portability allowance is not what we call generation skipping tax exempt, GST exempt. What does GST exempt mean? It has nothing to do with spokes and tires. That's something else completely. GST exempt means that this little trust here can not only benefit my spouse for her lifetime, but then can benefit our daughter for her lifetime, and then can benefit our granddaughter for her lifetime, and then can benefit her children for their lifetime, and never be subject to estate tax. And what if this 11 million doubles in value every 10 years for 100 years? 22 million, 44 million, 88 million, 100 million. 340 million. And I'm only 50 years into this thing. That's why the Biden administration would apparently like to tax trusts every 50 years. That's a Bernie Sanders proposal. I hope it doesn't pass. If it does pass, it is likely that pre-existing generation skipping trusts will pass estate tax-free. I'm reading right now a 1948 trust that's maturing when somebody's grandmother dies, a 1948 trust. And it was all hand typed in 1948. Everything was hand typed. And it's really a well-written trust agreement. And you can tell that it was typed in those days. Somebody would take shorthand, the secretary would take shorthand, and then the secretary would type it up. And if a mistake was made, they would have to start over and retype that page. So what we put in these trust documents is important. A South Dakota trust can go 999 years. You know, what planet will that trust be on in 999 years? I mean, I'm sure my Honda will still be running then. It's been such a great car. With Florida and Nevada, we only have 360 and 365 years. But as Einstein said, the time value of money is really an amazing thing. Now, what else does this married couple want to do? They want to put their life insurance into an irrevocable life insurance trust to avoid estate tax on their life insurance. Now, with a JES trust, a joint exempt step-up trust, there would be one trust for both spouses. They would share a trust. I mean, they share other things, hopefully not a toothbrush, but they would share a trust. And what's nice about the trust is, in my trust system here, which is what we normally use, if spouse one only has 7 million in assets, and spouse two has 7 million, and one dies, we're only locking up 7 million. But with a joint exempt step-up trust, when spouse one dies, two things happen. One, you get a full step-up in basis of all of the assets in the joint trust, asterisk, if it works, which we think it will. And then, secondly, the first 11,700,000 of the 14 million of assets can lock up in the first dying spouse's trust. Now, if you live in a community property state, most notably including California, Texas, Wisconsin, and Guam, those of you in Guam, because we do have a client in Guam, and he may be watching. Anyway, when you die with community property, you get a full step up in basis for all the property, but only half of it can go into a credit shelter trust. So we have community property clients who have converted their community property trusts to joint exempt step-up trusts. The third kind of trust that I can discuss today, because we have them now in Florida effective July 1st, is the community property trust. Anyone anywhere in the United States can have a Florida trustee as a co-trustee with them to hold assets in a trust for the spouses only, that gets a full step up in income tax basis on the first death. And that is pretty darn convenient, but that trust will be subject to creditor claims of the married couple. There's a time and a place for all these kinds of different trusts. Many of you have several different types of trust. And so I'm glad about that. Now, page 15, you've got each spouse has a revocable trust, or they might have a joint trust or a tenancy by the entireties trust, which we think is entirely possible, even though a bankruptcy judge in Orlando apparently doesn't think it's possible. And then you have an irrevocable trust for those lovely children, because most of you were saying, boy, Alan's lucky to have a daughter that he could give 0.5% of his voting stock to and not be concerned that she may turn on him. Well, I could set up an irrevocable trust for my daughter and my granddaughter, and I could make my daughter the trustee and have her hold 0.5% voting and 0.5 and 4.5% non-voting, and I can have the right to replace her anytime and any reason with somebody who is not related to me and who is not an employee of mine. So that's okay with me because I don't trust any of my relatives or employees anyway, haha. So, but I do trust my best friend from high school or someone I might meet like a lawyer or a CPA in the future. So if I want to control my LLC, I can, but on my death, big discount, and from a creditor claim standpoint, nobody's going to be able to take over control of that LLC. So that would be your multi-tiered. Now, we call this tiered because it has different levels, not because people cry when they see the bill after we are done with the work. Now, some of you may not have our amazing spreadsheets, so but I have talked about these spreadsheets almost every webinar, so we do have them here. Kelsey should have sent you the spreadsheet, which enables you to determine how fast your assets are going to grow, how much assets you have right now in net worth, the added savings every year, how much you save every year, and the number of years that you're going to be saving. But let me use this in a different way today. So here I've got in column 6, this individual has $10 million, and it's growing at 8.25% a year. So maybe that's a little bit unrealistic. Our investment portfolio that Marcia and I have had for 27 years now has averaged 6.5% a year, which isn't bad because there's a lot of very safe bond funds in there. So I'm going to reduce the rate of return to 6.25%. Now, we pay our investment advisor 0.25% a year. So I'm going to reduce that now to a 6% rate of return. And then I'm going to pretend that I can save $100,000 a year for the next 10 years until I'm 72 years old. After that, I hope I can work more. And if I follow this, and assuming that we follow this, I'll have $25 million in 2035. Now, what if I pay my investment advisor a full 1% a year instead of 0.25% a year? Watch that 25 million go down. I'm sorry. That 25 million just went to 23 million. So over 15 years, that investment advisor differential is $2 million. So you can use this chart for that type of thing as well. Okay, so we know the math is not the reality. When you have to run the numbers to see what actually happens. When Albert Einstein was trying to understand the 186,000 miles per second that light travels, he had to run the numbers. He couldn't just put his running shoes on and keep up with it. But $1 million invested at 7% compounded annually goes to $1,976,000 in 10 years, $3,009,000 in 20 years, $6,006,000 in 30 years, $15 million in 40 years. So what we're talking about here is a tremendous growth amount. All right. What if I accidentally give too much and I follow my advisor's advice? I put $11 million worth of assets into, I'm sorry, I put $15 million worth of assets in an LLC. I transfer a 99% non-voting member interest in that LLC to a trust for my daughter, a generation skipping tax exempt trust for my daughter. And lo and behold, the IRS audits me and says, this was not a $10 million gift. This was a $12 million gift. And since you had already used another $1,700,000 of your exemption, you owe us gift tax. And the gift tax is $800,000. And as my mentor, Sri Kumar Rao, said, good thing, bad thing, who knows? Is it a good thing that I gifted $2 million more than I thought I was, getting it out of my estate and letting it grow and letting the growth on it be out of my estate? Or is it a bad thing? And the answer is, it turns out to be a good thing. Because not only did I get the extra $2 million out because of the growth of the $2 million, because of my ability to pay income tax on the income of the $2 million, but it actually reduces the estate tax by significant amount. And here's why. Here's the example. John makes a gift of $2 million to his daughter. 40% of $2 million is $800,000. It reduces his net worth by that amount. Now, what happens? And here's the proof in the pudding. The value of his estate starts at $10 million. In my example, he's already used up his entire exemption. He waits until he dies. The estate tax is $4 million. What's left for the descendants is $6 million, which will buy a lot of pudding. Let's say instead that he gifted $2 million. He paid a gift tax of $800,000. What's left is $7 million too. Now he dies 3 years and 1 day later, because this doesn't work unless you live for the extra 3 years. His estate tax on the $7 million too is $2,880,000. Now, when you add $2,880,000 and $800,000, you get an amount that is less than $400,000 by $320,000. Now, even if he paid his lawyer $320,000 for the advice, that money would have been tax deductible, I believe, and he would still have come out ahead. Now, we use valuation adjustment clauses in our gift documents. So a client in our office never gives 99% of an LLC. The client signs an assignment document that says, I hereby give a percentage of ownership of this LLC, which is determined to be worth $10 million. And I estimate that this is a 99% gift. But if a court of competent jurisdiction in a tax case determines that the gift is more than that 99% is worth more than 10 million, then the amount I'm gifting will be a lower percentage of value, and any excess will have been kept by me. It doesn't come back to me. It's important that it say that it will have been kept by me. This is a formula gift. Even better, there are court cases which say that it's better to say any percentage, any amount, any percentage that would go over the 10 million will go to charity. And to even then give a small percentage to charity and write that charitable deduction off on your tax return. So if the IRS audits you, they know you're charitable, and they also know that they're not going to get any more money from you. The excess is simply going to go to charity. There were 2 court cases that have blessed this, and they were both appellate court cases, McCord and Petter. And we have a white paper on this. We've never finished the article because we always get interrupted, but we're writing a very comprehensive article on this that we wrote to make sure that we understand it. So yes, Jay, I did say that you should have received a copy of the Excel worksheet, but I forgot to ask that it be sent out. So it'll be sent out shortly after the webinar to those of you who have signed up and have attended the webinar. All right, here is the applicable federal rate of July 2021. And let's look at this. The short-term applicable federal rate is only 0.12%. So I could loan $30 million to the Trust for My Grandchildren, and it could invest in a short-term bond fund earning 1.5% on average. So 1.5% of 30 million is what, 350,000 a year that the trust earns, and then only has to pay me about $26,000 a year and keeps the difference. That is really good. Or what about a 9-year note? You can lock in a 9-year note at 1%. So if the client is old, you typically have the note balloon about at the client's life expectancy. There's technical reasons for that. So if the client is 80 years old and I'm going to do a 9-year note, I'm going to do 1% interest. So she loans $1 million to this trust. The trust is expected to earn a rate of return of 6% a year. That's 600 on 10 million. That's 600,000 a year, right? So then it only turns around and pays her 100,000 a year. It keeps the other $500,000 a year, and she pays the income tax on that for the trust. Or a 9-year note, bad news, over 2% now. We were spoiled. But the good news is, if you are selling something, you are allowed to use the published rate for the month of the sale, or the month before that, or the month before that. So count on my fingers, May, June, July. I can do a sale right now and use the May rate. What was the May rate? 2.16%. Okay, so I'm no better off. Sorry about that. So anyway, the rates are going up. It's time to get these done. But the client is 73 years old and has a published life expectancy of 12 years. Although most people who can afford to do this type of planning live past the life expectancy tables because they smoke less, they drink less, and they weigh less, and they exercise more. So they will usually live longer than the tables, but some people won't. And for them, we can use the self-canceling installment note at 6.6%. Or, for example, we have one client who has 140 descendants. It's not that hard to do. Just have 9 children and have them each have 9 children. 9 times 9. That's a lot. And then start having grandchildren at that rate, and you'll have 1,000 descendants. It's almost biblical. So they can make big gifts, but even that is not enough to keep their estate down below the exemption. So what do? We do a skin. That will keep their estate tax down, and they can use the extra interest to make gifts every year to all of those descendants. Of course, Bernie Sanders would limit the annual gifting to 50,000 a married couple. So not sure that that's going to work forever, but it's working now. Normally, you have the skin balloon at the life expectancy of the client because the software programs that tell you what the interest rate has to be assume a balloon at the client's life expectancy. But you do not have to make it balloon at the client's life expectancy. You can have it balloon after the client's life expectancy, but if you do that, the interest rate will be much higher, and you will have to also hire Jerry Hesh to run the calculation for you or remind me how to run the calculation. Although I have it in some handwritten thing that looks like Albert Einstein's blackboard thing there that you see behind me. Here's the alternative, the handy dandy alternative, and that is the private annuity arrangement. Now, the private annuity arrangement, and I could play the Mrs. Kite video for you. I think maybe next week I will, but it's on YouTube. If you look up Gassman annuity Kite, K-I-T-E, there is a Broadway actress who sang a song that I wrote called The Benefit of Mrs. Kite that explains the private annuity. But what you could do is sell a $10 million asset to a person or a trust in exchange for an annuity. And if you're 73 years old, that trust could pay you an amount equal to 8.97% of the value of the assets sold per year for the rest of your life. And when you die, the annuity stops and there is no estate tax whatsoever on the annuity. And what Mrs. Kite's family did was she was very sick and they had her sell her assets for an annuity that was customized to pay nothing to her for the first 3 years and then to pay a lot to her after that. She died within the first 3 years, and the annuity was not included in her estate for estate tax purposes. So not only did she remind us how great the song For the Benefit of Mr. Kite is from the Sgt. Pepper's album from 1967, which I used to play on my close and play phonograph every night before I went to bed, which is why I'm so strange now, but also established that the private annuity can be used in under the Treasury regulations. You can use the private annuity as long as you have better than a 50% chance of living a year, or you actually live for a year and a half after doing it. So even if a client comes to you and says, hey, bad news, lung cancer, 2-year life expectancy, what can I do? Let's get an opinion from an oncologist that you can live at least a year and a half, at least a year, and let's sell your assets in exchange for a private annuity. And then when you die, as I've said before many times, your family will be much less unhappy. The funeral can be fancier because you'll pay no federal estate tax. And people just completely forget about these techniques. Now, in order to make a private annuity sale income tax free, you have to do it to a defective grantor trust. And in order to do it to a defective grantor trust, to the IRS's satisfaction, the trust has to be highly capitalized with assets or guarantees that would allow the arrangement to go forward for many, many years. It's called the probability of exhaustion test. There's a very good Heckerling white paper by Larry Katzenstein, which explains why the probability of exhaustion test may not be a valid regulation. But I think these private annuities, very, very underutilized. With the self-canceling installment note, for many years, the profession, or at least the vast majority of us, believed that you could use the life expectancy regulation applicable to private annuities by simply putting the self-canceling installment note in place if you had a better than 50% chance of living a year. The IRS says, no, 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 a promissory note is not an annuity. Now, Howard Zaritsky's writings on this, until the Davidson case came out, said you should be able to use these tables because what is a promissory note? It's the same darn thing as an annuity. It's a payment over time. And I agree with Howard. I don't agree with the IRS. But the Davidson estate, Mr. Davidson, who used to own the Tampa Bay Lightning, sold it before they started winning. Sorry about that. But he also owned the Detroit Pistons, so he was no idiot. He did this private annuity sale. And he did get a favorable settlement from the IRS. But if you're going to do a self-canceling installment note and the client is not very healthy, then go ahead and consider using the SCRAT. And that's a term that our law firm came up with because we love to popularize techniques that other people invented so that we could take credit for it. And what you do is you put the private annuity note, you put the self-canceling installment note into a grantor retained annuity trust. And if the IRS audits you, then you end up taking more out of the grantor retained annuity trust. It's not the same technique that Steve Oceans came out with that a lot of people have criticized. It's something a lot different. And thanks to Steve Oceans, OSHINS, for all he's done for our profession, they have a great, great website. And if you're in Nevada, you could go visit him and you could write off your trip as long as the main purpose is to see him. Okay, page 39, I've shared this with you. many times. This is clients, let's just warm up here. They put $20 million worth of assets into an LLC. They keep the 1% voting member interest. They each sell a 49.5% non-voting member interest in exchange for a note. How much does the note need to be? Well, 20 million divided by 2 is 10 million multiplied by 66% or 70%. You end up with about a $6,900,000 note. You do need to make a seed capital gift to each trust before or simultaneously with the transaction. And you've converted 20 million worth of assets that will hopefully grow to $14 million in notes that are worth less than 14 million. 20 years later, the investments are worth 40 million and each trust is worth 13 million. More than half of the growth is gone based upon very, very small gifts. So let me go. I've got 16 minutes here. I'll talk about S corporate. Well, I did that recently. Let me go. I wanted to go to page 109 to boldly go where we have not gone before because we never get past age 70. I mean, page 70. I hope I get past age 70. I'll be there in 8 years. Page 75. This is the scrap. So this is for the tax lawyers and CPAs. If you're not a tax lawyer or CPA and you need to take a biological break, I suggest that you take it now. So this has nothing to do with a kitty cat. There is no tax on cats, not at least yet. So here's what happens. The client sells assets in exchange for a $1,500,000 note. Now, I think the note's worth $1.5 million, but because the client's not in good health, the IRS may say that the note's only worth $100,000 and that the client is making $1 million for gift. So here's what we do. We put $2 million worth of assets in the LLC. The client owns the LLC and takes back a $1,500,000 note. So I think the LLC is worth $500,000, and the IRS thinks that the LLC is worth $1.4 million. Now, the client contributes ownership of the LLC 100% to a grantor retained annuity trust, which says that the client will receive back an amount equal to 26% of the value of the LLC every year for 4 years. And I think that that is a $500,000 transfer to the GRAT, and my client's going to get back that's a $500,000 transfer to the GRAT. My client's going to get back about $130,000 a year for 5 years. No gift is considered to be made. It's a zeroed out GRAT. That gets the $2 million of assets out of my client's estate, gets her below the estate tax filing level. Now, the IRS comes in and audits it, says you owe a big penalty because you made a $1,100,000 gift. No, I don't have any gift responsibility. The GRAT simply owes me back $1 million more, an extra $900,000 over 4 years with interest. So there's no gift tax exposure. And as a practical matter, if this gets you below the estate tax filing limit, you will not pay federal estate tax. So that is the SCRAT. I stole the idea from Stacy Eastland in one of his outlines. So if it doesn't work, I'm blaming him. Now, page 79, I've got a Oceans, O-S-H-I-N-S. Okay, why am I so fond of LLCs versus FLPs? Well, FLPs have to have a general partner as a 1% or more interest and a limited partner as a 99% interest and are a little bit more complicated to draft. And a Florida limited partnership requires a $1,000 filing fee with our great Secretary of State and $500 a year in annual report fees. So we just find that LLCs are less complicated And while we believe that we're perfectly competent to handle drafting limited partnerships, many clients, for some reason I can't imagine, end up going to another law firm, and then the other law firm doesn't always understand how to handle limited partnerships, and then when they come back, it's all messed up. So there's nothing wrong with limited partnerships. We form them many times outside of Florida, but that would be the reason. Okay, so here on page 79, we're comparing the self-canceling installment note with the private annuity with the grantor retained annuity trust, and these are very interesting things to do. Now, page 80, what is the value of the promissory note? So Jerry Hesh wrote a great article in Bloomberg. He is such a great magician. He's a great magician with math. And in the Berkman estate case, there were 5 notes worth $275,000 each, 20-year notes, 6%, died in 1974 when the applicable federal rate was 9.75%. And this is why Jimmy Carter was not reelected, by the way, and got a 50% discount on the value of the note. Smith v. U.S., a $10 million note, entered into 1977, died in 88. Applicable federal rate was 7.57%, got about a 20% discount. The Harper case, a 12% discount. So again, people do ask me, why are you not going to just gift that 99% non-voting member interest and use up the $10 million exemption? And one reason is because the note is going to get is going to qualify for a very high discount. Now, page 83, we talked about the Community Property Trust. There is a great article on it, besides the one that we just published with Lineberg on Friday. The article by Zaritsky, Blottmacher, and Asher is excellent, and we plagiarized from it many places, but gave them credit in the footnotes. They just did a great job on the article. I highly recommend it. There are the community property states. We normally recommend that clients transmute out of community property status for creditor protection purposes, because if you live in California or Texas or Louisiana and you get sued, one spouse gets sued, the creditor can take all of the community property. And to transmute out of community property in Louisiana, you have to get a court order. You can't just do it on Bourbon Street after a few beers. That apparently happened too many times, so they require a court order to transmute out of community property status. So if you want our article on community property, which has a lot more detail than this, we will be glad to send that to you. And we also have slides here that explain the joint exempt step-up trust. Those of you who are laymen, please don't read these. You can hurt yourself. You can find the articles on this on the internet. And we even have a handy dandy, easy to understand chart on how the jest works at page 104. And I thank Christopher Denicolo for thinking up the name jest. We wanted an acronym that sounded like a real word. So we came up with Joint Exempt Step-Up Trust. And now, how long do you have to wait between funding the limited liability company and transferring by sale or gift the 99% non-voting member interest? And the answer is at least a few days. For some reason, and I disagree with the courts, but they never asked me my opinion, and they still never do. If I place assets in an LLC on Monday, and on Tuesday I transfer the 99% non-voting member interest to you, the tax court will say that I actually transferred 99% of the stock to you. So Mr. or Mrs. Holman transferred Dell stock to a limited partnership, and then immediately thereafter, actually 6 days later, transferred the limited partnership interest as a gift. And the tax court said, yeah, this is fine. You get a discount on the limited partnership interest. And I don't remember what the discount the tax court gave. It might only be 20% or 18%. But the service said, wait a minute, they did this right after they funded it. Shouldn't the stock be considered what was gifted? And the court said no, because stock goes up and down in value. There's a lot of this elasticity, especially Dell stock. So 6 days was enough. But the Senda case, they didn't wait a single day. And this was the standard of practice back in 2004. And the tax court said this was a gift of the assets. In the Jones case, they did the same thing. And in the Shepard case, the number of days varied. But we like to wait 30 days so that we don't have such an issue. Okay, for you daredevils out there, only you should look at chart 114. The conservative tax lawyers should cover their eyes. It is the best advice, perhaps, to recommend that anytime a client has a transaction with a trust or with family, that it should be reported prominently on a gift tax return, giving the IRS only 3 years to audit that return and contest the discount taken and whatever happened in that gift or transaction. But is it required to be disclosed? And the answer is sometimes no. And is it really best to disclose it? Because if you are not going to have to pay any estate tax, and you are not going to have to file an estate tax return, what are the chances that the IRS is ever going to look at this? Or if you are a frail person in your early 80s who does not want to spend money on an IRS audit, or for that matter, a gift tax return, and simply says, I'll do the transaction, but my kids can deal with the aftermath. I don't want to be anywhere around if the IRS shows up. That is not my cup of marijuana tea. So when do you have to disclose versus when you don't have to disclose? Well, if you're going to make a seed capital gift to a trust, if I'm going to sell a $10 million discounted LLC interest to a trust, I'm going to typically put a 10% gift, a $100,000 gift, or $1 million gift into that trust. And I might put something like cash or bonds or publicly traded stocks, something very innocuous to not attract an audit. Or if I don't want to file a gift tax return, I'll only gift up to $15,000 per beneficiary, give each beneficiary a 30-day or 60-day right to withdraw what I put in. That's called a crummy withdrawal power, named after a taxpayer named Crummy, who got a trust that was defective and crummy. We even charge extra for that. But if I keep it down to $15,000 a person, I don't have to file a gift tax return. What happens if I'm making $1 million sale and I only have one crummy power holder? Well, the trust could get a guarantee from one of the beneficiaries. The beneficiary guarantees that if the note goes bad, the beneficiary will pay up to $85,000. That should work. There's complexities relating to that we could explain in a subsequent webinar if anyone was ever awake. All right. Number 2, I fund a family LLC. Does that need to be disclosed? No. I'm selling a discounted interest to the LLC for a note. Does that need to be disclosed on a gift tax return? No. But should I disclose it? Well, maybe yes. So the IRS only has 3 years to challenge it and we know where we stand. Maybe no, because if we do, we may have to pay extra to get a better documented valuation report. And there's a better chance the IRS will audit the sale. Okay, how about later on if I want to use my exemption? Let's just say, hey, I know, Alan, that you said the note's not worth as much. I want to use that exemption up. Okay, you're going to have to report that on a gift tax return. Well, what if this month you do the sale for the note and on December 31st, you cancel the note? And then what goes on the gift tax return? The cancellation of the note. Or are you going to report the whole sale and the discount and all of that? So those of you who are tax lawyers and CPAs, you can look again. I moved off the slide. The discussion's over, but these are considerations that we can consider, which is why they're called considerations. But please, if you work for me, do not put the same word or a similar word in the same sentence or an immediately following sentence, or I'm going to have to change that word. In the old days, we used to have something called, what was that, a thesaurus that would have synonyms in them? Nowadays, it's all on Google, I guess. It's not as fun to leap through Google as it is to read the dictionary. There's really nothing as fun as reading the dictionary. Okay, Alan, I want to make the $10 million gift, but I want to reverse this thing if it turns out that the gift tax exemption is not going down. In fact, if the Republicans take over again, I think the estate tax may go away, and I don't want to have used my exemption. How can I reverse it? And the best way to reverse it is to use a lifetime Q-tip trust. I've got a mathematical example there, but I'll tell you how it works because we only have 2.5 minutes, also known as 3/10 of a billable hour to many of us. Page 122, the client has an $11 million note and transfers it to a Q-tip trust. What's a Q-tip trust? It's a trust full of all those little Q-tip swibs that you clean your ears with. There's a special loophole for them. If you buy $11 million worth of Q-tips, you'd have to go to several CVSs to get this done. Then you won't have to pay estate tax. Actually, a Q-tip trust stands for Qualified Terminable Interest Property Trust. It was invented by Ronald Reagan so that he could leave assets in a trust for Nancy that would then benefit his children after Nancy's death without having to go to Nancy, so he could still get the federal estate tax marital deduction. And when you fund a Q-tip trust for your beloved spouse, which has to pay her all the income for her lifetime, then you get the marital deduction if you make an election. And the election is by October 15th of the following year or September 15th, one of those two. So you do the Q-tip trust now, you put the $11 million in the trust, it pays income to your spouse, but it doesn't necessarily have to have income because it could invest in an LLC that doesn't pay it any income. And now, before September 15th of the following year, you make a formula election. And the election is, I elect the marital deduction, so it's not like I even made a gift, to the extent of $11 million. So if the note turns out to be worth more than $11 million, there's no estate tax, or there's no gift tax, because the excess qualifies for the marital deduction. By the way, I didn't say that right, but you might know what I mean. So you're gift tax proof, because if this is a $13 million note that I think is worth $11 million, and that would have been a gift, the excess over my $11.7 million exemption goes into a marital deduction part of the Q-tip trust. So I'm bulletproof there. Or if I decide I don't want to make a gift at all, I elect 100% marital deduction, and then I haven't used any of my exemption, and the independent trustee of the Q-tip trust can transfer the assets, all those little Q-tip things, all of them, out to my spouse. She can then go back to all those Walmarts and CVSs and return them, get your $11 million back, and you will have paid no federal estate tax, and you will have reversed your gift. So that is the story of the Q-Tip Trust. And that is my hour. So I'm done now, and I think I've answered, I'll answer a couple questions, and then I want to show off the Estate View software for the three of you still then remaining. Anyway, here's some questions. I could have the dummy answer the questions, but I'd have to move my mouth in order to do that, and I'm just not that good at it yet. Okay. Hi, if a decedent lived in Florida, would assets held jointly with the spouse be recorded on the Form 706 at 100% of fair market value or 50%? Thank you, Marie. It would be 50%, and it goes on Schedule, I think, J. Okay, Dave, do you do special needs trust? What's a good source of information for special needs trust? Dave, I'm going to send you my special needs trust language. Now, you should use a lawyer to review it before you implement it, and my language is only good in Florida, probably, although we have used it elsewhere, and I'm glad to send that to you. We wrote an article called Planning for the Addicted Beneficiary. If anyone would like, I'd be glad to do a half-hour article on that and on special needs trusts. Okay, good morning, Debbie. Can Nate sign our certificate? Nate, can you sign Debbie's certificate? I'll be glad to sign her certificate. Just send it over, okay? With $5. All right. The ventriloquism lessons are not going that well, but they're a lot of fun. Okay, I have no children. Well, you can adopt me. Nieces and nephews and sisters and brothers is what I have. I have no children, but they are childish. How does this affect creation of a pass-through trust to minimize estate tax in Pennsylvania? Moving is an option. Well, David, I've got good news for you. The Credit Shelter Trust will work for the nieces, nephews, sisters, and brothers, but if you move, they will still be childish. Only distant relatives like Chevy Chase movies with Cousin Eddie. That's what Jacqueline said. Thank you, Jacqueline, for listening. Did Alan say we should have received copies of the Excel spreadsheet? Yes, we will get that out to you. Anyway, let me go now. For the one of you left, let me go ahead and show you the Estate View software. The story is this: there used to be a software program that was not nearly as good as this, and it was called, I think it was called ViewPlan. A guy named Miller in California developed it, and I loved using it, and it disappeared. Somebody bought it, and then they didn't use it. So my son-in-law is a software engineer, and he's very brilliant, by the way, but don't tell him I said that. And I worked with Jerry Hesh, and we developed this from spreadsheets. So what you do here, top left-hand side, and by the way, you can make this a two-screen document. You can put different things on different screens. You can move stuff around. It's a lot of fun for everybody. But, ooh, where did it go? I lost my, where did it go? Where it stops, nobody knows. All right. Go to annual amounts, go to trust logistics. And what I can do here is I can load in the client's name, the spouse's name, the value of their house, the growth rate of their house, the value of their investments, the growth rate of their investments, the annual tax cost and the annual advisor costs for their investments, how much they save a year during the joint lifetime, how much they spend a year or save a year after the first spouse dies, whether their exemption is going to go down to half in 2026, whether they're going to have a portability allowance, whether they're going to do maximum funding of a credit shelter trust, depending upon when they die. And then I can also provide when they're going to die. If you don't like people, you can make them die early. If you like people, you can make them die later. It tells you what their life expectancy is, and depending upon whether they're a smoker or not. If you don't like them, you can make them smokers. You can let the surviving spouse, usually lives a long time because you like the surviving spouse more than the first dying spouse. And then once you've got that information, oh, let's make them richer. There we go. Once you have all that information in, oh, and how many children they have and how much they have already gifted to a trust. Say they have 5 children and grandchildren, and what percentage will be discounted limited liability companies, how much life insurance they have, and whether they would like to do an installment sale. And then once you've done that, I need to find my other slide that I moved away. Maybe it's there. There it is. Hooray. I rediscovered it. Oops, it went away again. Let me find it. Okay, there's my scenarios page. I'll move my scenarios page over. So my scenarios page thinks it's a separate page. Sorry about that, everybody. See if I can redock it. Dock. There it is. All right. Now what happens? Bob and Mary have $1,500,000 house. They have $15 million of investments. The house grows at 3%. They are adding $450,000 a year to their net worth. The growth rate on their investments, 7.48%. Bob dies in year 1, and there's no estate tax because they have $11,700,000 each of an exemption. If they're both lucky enough to die immediately, there is no federal estate tax. But what if they have life insurance? What if Bob has a term life insurance policy? He's paying $15,000 a month for it for 15 years, and it has a death benefit of enough to make him estate taxable. How much does that have to be? Oops, there he goes. $7,950,000. So there's a big estate tax unless he puts it in an irrevocable life insurance trust. I click there, irrevocable life insurance trust, and the estate tax goes away. Take back the irrevocable life insurance trust, $835,000 estate tax. I think everybody's probably following that. So, but let's say that they don't go on vacation on the same airplane and they actually live to their life expectancy. I go here and I click no planning. When I click no planning, it shows me that in year 11, the house has grown to $2,083,000. The investments have grown to $38 million. The life insurance is still $7,009,000. Mary in year 20 has a net worth of a lot, $2,700,000 of the residence, $6,500,000 investments. She does have a portability allowance. So her estate tax, $19 million. Now, if she remarries and loses her portability allowance, her estate tax is $22 million. That's a pretty big estate tax. But now they're going to use the credit shelter trust, also known as the bypass trust. On the first death, the maximum amount that can be placed in that is $8,060,000. That's what they do. I click bypass trust. Voila! That's French. What happens now on Bob's death? Mary gets an $8,060,000 bypass trust. It grows at 7.48%. The estate tax is now down to $17 million. The bypass trust will be $14 million in year 20. Now, just to show off, keep in mind, now Bob says, wait a minute, I forgot about the condo in Maui. We're really worth $17 million, but I'm a pessimist. Let's go with a 5 million growth rate. Okay, go with a 5.48% growth rate. You're still in estate tax land. So Bob says, well, I think that there will be a portability allowance. Okay. And I don't think the exemption's going down. Okay. Now your estate tax is $4,000,004. But if you'll go ahead and do the annual gifting, $15,000 per child and grandchild for the 5 of them, Now we're going to have a gifting trust. It's going to be worth $7 million too. Talk about the time value of money. Oh, why is it worth so much? Because they already started with 750,000. But if we say they started with nothing in the gifting trust, if we reduce that to 0, then the gifting trust still has, it seems like a lot, 5 million. Not sure why, but it does. All right. But if they do discounted gifting of LLC interest, discounted LLCs, they'll have more in the gifting trust, less estate tax. With the life insurance planning, down here, oops, there it is. You see the life insurance included in his estate until, or we take it out, it's not in his estate. And then finally, an installment sale. So here's the dramatic math of the installment sale. I go down here, I'm going to make a seed capital gift of 250,000. I'm going to put, or let's make it, well, you know what? They won the lottery. They won the lottery. So now they're up to a $27 million net worth today. And they have a really bad situation. It's not bad breath. It is estate tax. Even with all that planning, a $10 million expected estate tax. What do? Well, let's put $5 million worth of, or let's put $5 billion worth of investments into an LLC. So I go here with 5 million. Let's assume a 30% valuation discount. Therefore, oops, forgot that. I'm moving this. 5 million goes into the trust. Let me just move that to 5 million. That's at 5 million. Well, 5,142,000, 30% discount. So the sale is really worth 3,600,000. So I do a 3,600,000 note. I need a seed capital gift of 360,000. So I could just type in there $360,000 because I took typing class in 8th grade. And now I click installment sale, and my estate tax is down to 7 million. So for a $250 note, I mean a $250,000 gift and a sale, I have brought my estate tax down to 7 million. But what do I have to sell in order to get the estate tax down to 0? And I click up here until the estate tax goes to 0. And I need to put 15 million in an LLC with a $10,950,000 gift made. So I'm going to move my seed capital up to $1 million there. And now that move took my estate from 10,000,009. Now, this assumes that they die in exactly these years. What if I want to change the years around? One way to do that is to use the timeline. And the timeline, which I think was really brilliant what Dave did here, shows me what each trust is going to be worth each year for this period of time. So the blue is the installment sale trust. The red is the gift trust. The yellow there is the credit shelter trust that opens up on the first death. The personal residence is this dark green, and then the brighter green are the investment assets, which you see get put into the credit shelter trust. And then the red is the estate tax. So look at this, unbeknownst to me, although I did enough of an installment sale to get them down to no estate tax in 2045, I still had an estate tax here, although a little bit in those years. So I'm going to go back down and I'm going to increase that installment sale again to where it needs to be so I never have an estate tax. and then I'm going to increase my seed capital gift a little bit. I can play with these numbers pretty quickly. What if Bob dies earlier? Well, all I have to do is move that line, and he died earlier, and I'm still estate tax proof. It's fine if he dies earlier. I'll let him know. What if he dies later? I'm still good. If he dies much later, I'm still good. And Mary's good too. What if Mary dies before Bob? Okay, watch this. Mary dies before Bob. Boom. That's the result. We've reversed the order of death. What if she dies a little earlier, a little later? We're still estate tax proof. So now I want to write them a letter. How long will it take for me to write a letter explaining all this with all of these pictures in the letter? Okay, I want you to hold your breath as I click on Generate Client Letter. I clicked on it, and the letter is here. This is the letter. It's a Word letter, and it explains the estate tax system. It gives you all the assumptions that we put in there, and then it explains them. And we'll go ahead and send this to all of you so that you can play with it. And if you'd like to improve it, please do, because it always needs to be improved. Now, we also have an installment sale calculator. This is the second module of the program. And what I can do here is I can say, Bob is single, 25 million of assets. He saves, let's see, he saves, just pop this up, he saves 150 a year. His growth rate, 7%, pays income tax of 1% of the value of his assets. He's used 250 of his lifetime exclusion. He's going to make a seed capital gift of 600,000. He's going to put 6.7 million of assets into the trust. He's going to use a 35% discount. Let's move this up. He's going to put 8,369,000 of assets in there. It's going to be worth 5.4 million. His note's going to be 5.4 million. Interest rate, his interest rate will be 2.32%. 40% estate tax. Consumer price index, 2.96%. The note is conventional, not self-canceling. The note is a 20-year note or a 19-year note, which is his life expectancy. And we're going to show you 22 years. So now, what do I have? I have a spreadsheet. I can make it bigger or smaller using this. Let's see what the spreadsheet says. Initial assets, 25 million. Assets other than the note, none. He put it all in there. Growth after taxes is shown in this column. How much he spends is shown in this column. His annual note payment is shown here. He's going to get 126,000 a year. He's going to pay income tax of these amounts each year because it's a defective grant or trust. Here's his taxable estate, mostly consisting of the note. Here's his estate tax exclusion. Here's his estate tax liability. Here's how much he has saved in estate taxes by entering into this plan. And here's the trust. It starts off with a $600,000 seed capital gift. Then it's worth significantly more because it has 8.9 million of real assets minus a 5.4 million note. It pays no taxes. It pays the payment on the note, which causes the assets to get smaller, but it also has the growth. So in 2034, the trust is worth $13 million. But what if we make the note self-canceling? Click there. The note's now self-canceling. Turn up the interest rate to, let's say, 8%, which might be, based on his age, might be accurate. So now, if he is lucky enough to die in those first years, his estate tax is going to be zero, or it should have been zero. His estate tax is going to be based only on his remaining assets. His estate tax savings will be significant. Even if he outlives the note, or the note's not self-canceling, he's still saved because of the payment of income taxes on behalf of the trust and because of the discount taken on the sale. So we're going to learn how to move this spreadsheet out of the software program to a real spreadsheet, because it's really good to be able to spreadsheet these things. Right now, we have clerks enter it onto a spreadsheet. So that completes our 1 hour program for today. Somebody asked me, why do you work on Saturdays? My answer is, you call this work? Maybe it is to you, hasn't been for me so far. And also, if you're interested, we started out with 230 viewers, and we still have 187, meaning that you really don't have much of a social life. We will send in approximately 1 hour, thanks to Kelsey, the amazing Kelsey, what you've requested, and also the video of this. We'll be putting this on YouTube also. Keep those cards, letters, and gifts coming, especially the gifts, and have a fantastic weekend. Thanks again. Please suggest topics and suggest questions. We love to answer them. Thank you very much. Kelsey, can you turn it off now?